The Financial Planner, presented by BSC, Investors Protection Firm.
Hello and welcome. You're watching Financial Planner, and joining us today in the studios is Hemant Rustagi, CEO of Wiseinvest Advisors. Thanks, Hemant, for joining in this evening. Hemant, that's all eyes on the 29th of Jan, when a lot of us are hoping that the Reserve Bank of India will go ahead and cut interest rates. We only look at the positives of it because it's great for the equity markets, it's great for corporates, it's great for businesses, it's great for borrowers, and of course, people like you and me obviously stand to gain. But there's obviously two sides to a story all the time. Take us through, why is falling interest rates actually good, and why is it bad? And if it is bad to begin with.
Well, Samina, I think I personally feel that falling interest rate regime is actually a mixed bag. On one side you have borrowers, as you rightly mentioned, and on the other side you have lenders. Now, obviously, a lower interest rate is a great news for the borrowers because they get access to finance at a cheaper rate. But it doesn't happen immediately after the RBI announces the rate cut. It takes time depending on the kind of loan you are taking, the tenure which you are taking. So it takes time for you to get the benefit. It even benefits all those who have already taken a loan, but even there again it depends on the kind of loan that you have taken. Now, for example, if it's a floating rate housing loan, now you as a borrower will get the benefit after some time. So I think the borrowers need to be very alert enough to see whether the bank or the housing finance company from where they have taken the loan is actually reducing the rate or not. If not, they should take it up with them, or maybe it will be time for them to look for refinance for somewhere. I think a word of caution for borrowers here. Typically what happens when the interest rates go down, there is a tendency to borrow more. The reason for that is that as a borrower, I'm comfortable with paying a certain amount of EMI. And if I feel that, okay, I'm now getting access to cheaper finance, which means my EMI is going to be lower than what I thought initially, then the temptation is, why not borrow more? Right. So I think that is where borrowers need to be very careful, not get carried away with this. In fact, if possible, they should use that additional amount that they have as surplus for repaying the loan faster, because it's better to get rid of the loans as quickly as possible. On the other hand, you have these lenders.
I'll just come to lenders in a minute. I think the other thing that a lot of borrowers probably get caught in is when you see rates moving down, it's not as if you instantly go and apply for a loan. You might get tempted to wait it out and hope that there'll be further rate cuts. Does that happen often? Because it's more or less a dilemma where, you think the rates are going to go down and you continue waiting it out, hoping that there'll be more rate cuts to follow.
It's like trying to catch the bottom in the markets. Same thing applies here. As a borrower or as an investor too, if you're keeping an eye on the interest rate scenario, you get fair idea of whether for example, look at the current scenario. We all know the interest rates are set to go down. Obviously, it's going to take a year or so for them to really bottom out. You can wait for that long, but there is no point keep waiting because you don't know when there is a reversal in the interest rate cycle. So I think you can wait for some time if there is a possibility, but you can't wait endlessly for it. So I think it's better to go ahead. In any case, if it's a floating rate loan,
and you'll be impacted positively
absolutely.
Anyway.
In longer run, it will change a few times. So I don't think you need to really put so much focus on that.
Okay.
So as far as the lenders are concerned, there are investors who invest in fixed deposits, then debentures, bonds. Okay. Now it's not a good news for them. Whenever there is an interest rate are lowered, it's not a great news for them. The reason for that is because the returns that are offered by these instruments are basically aligned to the prevailing interest rates.
Right.
But there again, it doesn't get impacted immediately. It takes time. But fortunately for them, it doesn't impact their existing investment they have already made. So if the investments have already been made at a higher interest rate, they continue to earn on those rates on that. But there is a reinvestment risk here even for those investments. Now what happens is, if your earlier investment matures during a period when the interest rates are going down, you got to then reinvest at a lower interest rate. So there is a reinvestment risk even for the investment that have already been made at higher interest rate. So I think, like I said, it's a mixed bag. It's obviously not a good news for investors, especially those who rely on debt instrument, to take care of their regular income needs.
What about investors who are not investing in the debt market just yet and are looking to make fresh investments in the debt market? Should that be done before the 29th of Jan, when most of us are betting on a rate cut? Are you going to see a lot more participation coming in over the next couple of days?
Well, there are two kind of...
try and lock into that interest rate?
See, there are two kind of instruments that we're talking about here. One is the traditional instruments, okay, like you have bond debentures and all. We've already seen the interest rates have come down. Okay, they obviously are not waiting for RBI to reduce the rate. You see the trend. You already see, for example, this year tax-free infrastructure bonds are offering you lower than what they offered last year.
Right.
So you're already seeing the impact.
You've already preempted the move.
Absolutely. So I think that is what happens. I mean, that is what has already happened. But it's a great idea again for someone who has a lump sum. And when you see that the interest rates are going to fall in near future, maybe to lock in money at a higher rate. But obviously that cannot be done by every investor. Where it matters is basically the market-linked instruments. Now, typically what happens is that is where I think investors need to be careful, because you're taking a call. Now, if the interest rate does not happen, or it does not happen in the manner that is being envisaged by the market, then there can be a reversal. That's why I think they need to be careful.
So all verticals of the debt market are impacted negatively when interest rates start moving down?
Yeah, absolutely. See, what happens is, like I said, if you're talking about a market-linked instrument, there is an inverse relationship between the interest rate and the bond prices.
Right.
Now, what happens when the interest rates start going down? The existing bonds are more in demand, the prices move up, but the new bond, because they offer lower return, there is no demand for that. So I think that because of the inverse relationship,
right,
that's where I think investors need to be very, very careful.
So what is one supposed to do in order to enhance the returns they get on their debt portfolio? Of course, you can't take unlimited risk. So keeping risk in check and still enhancing the returns on these debt investments.
I think one of the options, like I said, is obviously to look at market-linked instruments. But investors need to be very careful in terms of selection of funds. Now, for example, if you look at the variety of debt funds which are being offered by the mutual funds, you have an ultra short-term fund, you have a short-term fund, you have income fund, you have hybrid funds. Now, the major differentiator between different kind of debt fund is the maturity duration of their portfolio. The longer the maturity duration of a portfolio, the more volatile the fund is likely to be, and the more it is going to benefit from interest rate fall. Similarly, if you look at a fund which has a lower, maturity duration, shorter maturity duration, there the impact of the, interest cycle is not going to be that much, but the volatility also is going to be less. So they have to be very, very careful. For them, the key factor is they need to first look at what is their time horizon. For example, in the current market-like scenario, if somebody has a time horizon of 18 months or 24 months or thereabout, income funds, especially the dynamic bond funds or income fund, especially the duration play funds, can be a great option here. But investors need to be prepared for the volatility. Now, volatility is taken care of provided you are committed for a fixed period. Similarly, if you look at ultra short-term fund, the money that you put in your saving bank account is earning you 4.5–5%. Some banks are giving 6 or 7, but there are exceptions. If you compare that with ultra short-term fund, the ultra short-term funds not only will give you more return, but they're also more tax efficient. So one, the benefit of looking at the market-linked instrument is that you can hope to get higher return. The second advantage is tax efficiency. Now, what happens when you invest in a traditional investment option, and if you happen to be in the highest tax bracket, you will pay 30% tax. So if you earn, let's say, 9%, 2.7 goes into tax. What you're left with is 6.3, which is lower than the average inflation rate, which means that you are going to struggle to beat inflation. If you get the same return, similar return, let's say in a tax-efficient instrument like a debt fund or a short-term fund, what happens there is that after 1 year, you can claim indexation, or you pay tax at a flat rate of 10%. Now, if assuming that inflation is at 7%, 9 minus 7 is 2, you're supposed to pay tax only on the 2%, where you pay 20% tax, 0.4. So your post-tax return is 8.6. There's a huge difference. So I think, like I said, one is you get a chance to earn higher return. Right. Second, the tax efficiency of this instrument can make a huge difference. So I think it's time for investors to realize that the traditional, options which are there may not work at all times. They can give you good return when the interest rates are high. Maybe you can lock in your money for a certain fixed period. But whenever you see a reversal in the cycle, you have to look at market-linked products. So maybe it's a great idea for investors to have a mix of these two to enhance their returns over a period of time.
Hemant, and we've seen this from the start of this year, there's been so much of optimism on the street. The Nifty is trading at 6,100, the Sensex is back at levels of 20,000, all in hopes that the Reserve Bank of India will come out and cut interest rates, which they've not done in the longest time. In a situation like that, equities are outperforming every other asset class, and there's a lot of money that's coming in, not from retail participation, but the general hope that things will get better. In a situation like that, most people would be tempted to move all their money out of debt and put into equities because there is outperformance there. Is that advisable?
Well, you're absolutely right. Falling interest rate obviously is good news for the stock market because the corporates have access to cheaper finance, and that enhances their, improves their profitability, and that in turn pushes the stock prices up. But there are some smart investors, experienced investors, try to time the market, and we call it strategic asset allocation, to try to change the allocation depending on the market mood. But then let me just make it very clear here. It is not something that every investor should be doing or can do. In fact, even the most experienced investor, even the most experienced fund manager, struggle to time the market, successfully on a consistent basis. For a retail investor, I don't think it's a great idea. What the retail investor need to do is to follow and have an investment plan in place, follow their own asset allocation. The biggest advantage of following this philosophy or the strategy is that when you decide your asset allocation, you look at certain factors. The factors are, you look at your time horizon, you look at your own risk profile, you look at your investment goals. Based on that, you decide your money, how much has to go into equity and debt. Now, which invariably means that only the long-term money will go into equity. And when you go with a defined time horizon in your mind, the biggest benefit of that is that if there is a volatility later, you are not disturbed with that because you know that you are there for 10 years or 15 years. And second thing is that you follow a disciplined approach of investing on a regular basis. I think that is what a retail investor should do. So I would urge all the retail investors to follow this model rather than trying to take advantage and move money from debt into equity, and when they see the volatility and moving it back to the debt. I think that is not a strategy that works. And if they keep the discipline of rebalancing their portfolio once a year, which means that if I start investing with an asset allocation of 50% equity and 50% debt, and if the markets go down, I see my allocation of equity going down to 35 to 40%. That is a time if I rebalance, I will move money out of debt into equity. Now that is the right strategy and the right time to do it, rather than trying to catch the market when it's already on its way up. Similarly, when the markets go up, and the 50% becomes 65 or 70%, that's a time for you to actually pair your exposure to equity, bring it to debt. I think that is the strategy or the philosophy if investors follow. I think they can actually get a lot out of their equity portfolio rather than, like I said, trying to chase the market performance and move the money, at random.
Hemant, just talking about your equity portfolio in an interest rate regime which is falling, are there any specific funds that one should look at? I'm talking about equity specifically, or any sort of particular mutual funds or sector funds that will outperform in a falling interest rate regime?
Well, obviously the interest rate sensitive sectors will benefit from that. There is no doubt about it, provided the rate cut happens the manner in which is being envisaged by the market. But as far as the retail investors are concerned, I believe they need to look at equity as an asset class, look at well-diversified portfolio funds. And the reason for that is, if you invest money in a fund which has been doing well consistently over a period of time, which clearly indicates one thing, that the fund manager would have invested in those sectors which are doing well. So because the fund manager is investing on your behalf, he's aware that the interest rate sensitives are going to do well. So he's already would have moved or will be in a process of moving.
Definitely give him your
money.
I
don't think retail investors need to actually replicate that model. Yes, if you are a savvy investor, if you understand, if you already have a well-diversified portfolio, this is the time for you to look at certain interest rate sensitive sectors like banking or auto or a couple of these sectors. But like I said, it's only meant for those investors who already have a large portfolio and are well aware of the fact that sector funds, even though they have potential to do well, there are also attendant risks too.
Right. Well, that's all about falling interest rates and how it affects you as a borrower and an investor. We'll take a break on that note. We'll come back and take your financial planning queries up, so stay tuned.
The Financial Planner, presented by BSC, Investors Protection. Financial Planner, presented by BSC, Investors Protection Firm.
Welcome back. You're watching Financial Planner. It's now time for us to take up your financial planning queries.
Investment Ladder, presented by BSC, Investors Protection Fund.
Hemant, we've got a query from Sahil Narang. He says he's got some surplus NRI funds of about 8 lakh rupees, which he wants to park for the short term till he has to repay his loans in September, October 2013. He asks, what is the best way to do this? He learns that NRE deposits come for a 1 year plus 1 year plus only. Would liquid funds be okay for this? If so, what are the top funds in this category?
Well, he's absolutely right. The minimum period for a term deposit of NRE is 1 year time. So obviously, since his time horizon is say 9 to 10 months, he can't be looking at that. Although I think not only he'll get a good return there, but also the returns are tax efficient. But since he does not have the time horizon, he will have to look elsewhere. He's again right that the mutual funds can definitely provide him a good option there. But instead of looking at a liquid fund, my recommendation would be, because you have a time horizon of 9 to 10 months, that he should be looking at either an ultra short-term fund or a short-term debt fund. Okay, and even there, I think to increase the post-tax return, he need to look at the right option. If he's opting for ultra short-term fund, he should be looking at a daily dividend reinvestment. Now, typically what happens is the debt funds have to pay a dividend distribution tax. For individual, it is 13.52%. Now, if he happens to be in a 30% tax bracket, there is a great tax arbitrage for him, as against 30%, which he would, for of course NRE, there is no tax there, but if he is to compare with other instrument, then it is more tax efficient. And if he's looking at a short-term fund, maybe then he can look at dividend payout. Some of the fund that I can recommend to him that he can look at, in the ultra short-term fund, he can look at Kotak Floater long-term, and in the short term, he can look at either Birla Dynamic Bond Fund or ICICI Pru short-term fund. So one of these funds, depending on which category of fund he decides, or he can maybe do a mix of these two in the category and then start investing.
Right. Hemant, there's another query coming in from Rajan Mishra, and Rajan says he wants to invest 12 lakh rupees in mutual funds for about 2 to 4 years. He says, how does he do this? And he plans to put his money in only top 3 equity diversified funds and 1 gold ETF, which is a Reliance fund. Is that okay? Do you have any suggestions on that?
Well, Samina, this time horizon is 2 to 4 years, not long enough time horizon for him to make portfolio very aggressive. What is indicated that he's looking to invest in a gold fund, which is all right, but he's also looking at investing in 3 diversified equity fund. If it happens to be finally that he has time horizon of only 2 years, or maybe even 3 years, investing aggressively in equity fund is not a great idea. My view is that he should be looking at a portfolio which is a debt-oriented hybrid kind of portfolio overall, which means the focus has to be more on debt and some part of it can go into equity. Now that he can achieve through investing in different kind of funds. For example, he can look at a debt-oriented hybrid fund. In that category, he can look at a monthly income plan, the growth option for that, because his time horizon is at least 2 years. There he can look at Reliance MIP, and he can invest around 5 lakh rupees there. This is a fund where 80% money goes into debt and 20% goes into equity. He can look at one equity fund, which has to be a pure large cap fund. He can look at DSP BlackRock Top 100 fund, where he can invest 2 lakh rupees. And the remaining 5 lakh can go into a multi-asset class fund. So this is a fund which invests in debt, equity and gold. Okay, so he need not have a separate gold fund here. He can invest 5 lakh rupees in that. There he can look at Access Triple Advantage Fund. As a combination of that, if he looks at, I think broadly his allocation would be around 70% or in debt and 30% in equity, which I thought for a time horizon like this will be apt.
And this is all going to be lump sum investments, right?
Yeah, because majority of it is going into debt. And in any case, we are talking about equity market doing well from here. So there is no point, because he does not have a long enough time horizon for him to invest through SIP or STP. What typically happens if it takes 1 year to invest, there will be hardly any time left for the money to grow. So I think we should go for lump sum and create a portfolio where, as said, the focus has to be more on the debt than equity.
We'll take a break on that and we'll come back and take some more queries, so stay tuned.
The Financial Planner, presented by BSC, Investors Protection Firm. Financial Planner, presented by BSC, Investors Protection Firm.
Welcome back. You're watching Financial Planner. We've got some time for another quick query from our viewers. Hemant, Raju Shah writes to us. He says he's 33 years old. He's got a 1-year-old daughter. He earns about 1.5 lakh per month. He has some loans, so he's paying an EMI of about 40,000 rupees per month, and he can save about 40,000 rupees per month as well. He's got an SIP of 10,000 running in an HDFC equity fund. He contributes 10,000 to his PF account every month, and he wants to invest for his retirement and his daughter's future education. How does he go about doing this?
Well, one of the important features or one of the factors that every investor needs to remember, especially when they're investing for the long term, is to start investing early. And this is what exactly I think Raju is trying to do. He's 33-year-old. He's got another 27 years before he goes for retirement. His daughter is just 1 year old. So maybe there is a time horizon of around 18 years before he needs the money for higher education. So this is the perfect time to do that. Now, I believe that, what he needs to do is he has established his goal. One is retirement, one is the daughter education or marriage. He needs to assign time horizon. I try to help him by putting the time horizon there. He also needs to set a target. Now, the right way of doing that is to first ascertain what is going to be the cost of education for a daughter, for example, in today's cost. So if I'm trying to help him by, taking one example, assuming that the cost of that education is 25 lakhs today, and the money is required after 18 years from now. So if you assume inflation of 7%, okay, he's going to be needing 85 lakhs after 18 years. So every investor should remember, consider inflation before you set your targets and start saving for that target, not for the current value today. So in this case, for example, because the time horizon is 18 years, he can invest in well-diversified equity fund. So if you assume an annualized return of around, let's say, 12%, he needs to invest around 12,000 rupees to achieve that. So that is again another benefit. Even though the target is huge, because there is a time on hand, you can actually achieve this target by not investing a huge sum of money. So if he invests 12,000 rupees every month, he can achieve the target. Similar thing he needs to do for his retirement plan. because his time horizon is 18 years and more, he should be looking at, like I mentioned earlier, well-diversified equity funds. Some of the funds that he can consider is ICICI-focused blue chip. He can look at HDFC equity. He can look at Reliance Equity Opportunity, and maybe look at one gold fund, which could be a Reliance Gold Fund or it could be a Kotak Gold Fund. Of course, one important thing he needs to remember, these are long-term goals. In addition to that, he's going to be some short-term, medium-term goals. He needs to create a separate portfolio for that. And there the focus has to be more on the debt, not on equity, to ensure that there is proper liquidity, there is a balance between risk and reward in terms of overall portfolio. So by doing this, if there is a need of funds later on, so he should create an emergency fund for that. So he will not touch his long-term investment and continue to grow.
Investment Ladder, presented by BSC, Investors Protection Fund.
With that, it's a wrap on this edition of Financial Planner. Thanks for watching.
The Financial Planner, presented by BSC, Investors Protection Fund.